Let's turn to the advisory now. Many Australians are unaware that superannuation can incur a 17% death tax when passed to adult children or non-dependents. But with proper planning, families can save thousands, tens of thousands maybe, in taxes. For more, Roger Perrett joining us from Freshwater Wealth. Roger, good to see you.
Yeah, thank you.
But hang on, we don't have death taxes in Australia, so what are we talking about?
That's right. It's a bit of a misconception, isn't it? We don't have death tax, but although superannuation is fantastic for funding our retirement and saving a lot of tax along the way, there may be tax when you pass away, so certainly a consideration.
All right, so how are you taxed then?
Yeah, in terms of how it works and what have you?
If you die and you have super, what's the treatment? Yeah,
sure. So maybe I'll explain the calculation. So effectively any money that you put in personally from a bank account and there's no tax deduction, that all still comes out tax-free. So it goes in tax-free, comes out tax-free, so that's not the concern. The death tax or the potential death tax comes about where a tax deduction has been claimed on a contribution. So it's all those contributions your employer's made, or salary sacrifice contributions, or contributions you've claimed a tax deduction, and even the growth. All those scenarios, that's where the death tax is calculated.
Well, in fact, there's the you can take a look at how how it is calculated. Then, so you need to clearly get ahead of this before you die, ideally.
That's right, yeah, exactly, yeah. So there's a couple of scenarios where it happens. So just as a recap, once you retire, all the money from superannuation that you receive is tax-free. If we go through then the scenarios when we pass away, if you pass away and the money goes to your partner or a financial dependent, so a child under 18, there's no death tax, so we're all okay. The clanger or the real tough scenario is if you're single or you're a widow, or money you put in your beneficiary nomination where the money is going to a non-dependent. So that may be like an adult child, for example. That's where we're going to get that death tax on those contributions where a tax deduction's been claimed.
All right, so, it goes to the question if it's worth contributing to super if there's a death tax then.
No, that's right. That's a very good question. Yeah, exactly. Because we can manage it, we can reduce the death tax. I wouldn't rule out superannuation. And let's face it, you don't pay any tax on superannuation in retirement, and you could be retired for 25 odd years. So you wouldn't disregard using superannuation for the death tax just because the tax benefits are so great.
All right, so we talk about what those scenarios there when death tax is paid and when perhaps is tax-free. What do we need to consider there?
Yeah, sure. So I think probably what we should consider is how do we potentially minimise these taxes. So, so I'll give you three which are quite common. So the first one I say is a bit tongue-in-cheek because if you retire and you live to 100 and you spend all your money, obviously there's no death tax, you've spent all your money, there's no money to tax. So obviously that's the ideal scenario, but it doesn't always happen. The second scenario is if someone was single or widow, so let's just say you're a couple now but your partner's unfortunately passed away. If you were ever spoken to by a doctor to say get your things in order, you've got a limited life expectancy, this is when we need to act fairly quickly. I had a scenario a couple of years ago where I'd primed this lady for many years about this scenario, and unfortunately she did call me from the hospital bed and she said the doctors have given me two weeks to live. And we'd spoken about what to do. Now because while we're in retirement we can take the money out tax-free, that's immediately what we did, because if we took the money out while she was alive it was tax-free. If she passed away with the money in there, there'd be that 17% death tax. So again, it's not a robust strategy because we don't know when our time's up, but certainly a strategy if you're in that situation.
Well, as you say, most of us do not know when we're going to die, so trying to time it is obviously difficult. But you're saying obviously the best way is perhaps just to spend it all before before you leave. You also look at potentially a recontribution strategy. What's that involve?
Yeah, that's right. So if you're over 60 and you want to prepare for this, what we can do is we can take out the money from superannuation and then we can recontribute it. And because we're recontributing without that tax deduction, what it means is if you then pass away in those scenarios, there's no tax. So it's a really common strategy. There's no issue in terms of getting the money out, but there are restrictions in terms of getting money back in. So it's one of those strategies that we'd really recommend that people seek advice, but certainly a really good way to manage that potential death tax.
All right. So overall, I mean, how much, if you take these strategies, how much could you save?
Oh, literally hundreds of thousands. That the client I just shared in that story, basically, I'll give you an example. If she had like $1 million and it was all taxable at 17%, that's $170,000. Like $170,000. Like, it's a lot. Some people we talk to, they go, I don't care, I'm not around. But some people go, $170,000. I'd rather my kids, my adult kids, get that money rather than the ATO. So it can really amount to a lot, and especially we can save that if people get advice and implement the right strategy.